Good morning and welcome to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend Cameron May, as usual, here on Wednesday mornings. He's going to be helping out in the chat. Welcome to all of you, whether you're joining us for the first time or the 100th time, and whether you're on the live version, the recorded version, we appreciate you being here. We're going to talk a little bit about volatility. We're going to talk a little bit about calendar spreads this morning. We're going to manage our 14-7 idea that we've been talking about. We're going to talk about position size in this discussion. So without any further ado, we're going to jump in and get right into this discussion. But a quick reminder, of course, everything we talk about is simply for illustrative and educational purposes only. It is not a recommendation of any kind of specific security or strategy or account type. Remember that equity and index options carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. Also, remember, because we're talking about index options, the majority of the index options we're going to be discussing are European style indexes, which means that they cannot be assigned. You can't see early assignment in those options. They can't be exercised until expiration. Therefore, it takes that early assignment risk out of short legs. That's going to be important in some of the strategies we're going to discuss today. We're also going to talk about technical analysis. It is not the only way to look at the market. It is not a guarantee by any means. It is theoretical in nature, as is every way of looking at the market. We're going to be using the Thinkorswim desktop software platform, specifically the paper money version today. Now, it does not do certain things like facilitate the early assignment of short options. But since we're talking about index options, we're going to be focusing on European style. That's not going to be an issue. Just keep that in mind, though. Also remember that investing involves risk, including the loss of principal. And when we talk about stops or stop limit orders, remember, even in index options, stop orders are not a guarantee of the execution price, simply the activation price. And there is the potential in the case of a stop limit order that the order gets gapped around and does not execute. So keep those things in mind. I'm going to jump right over here to the Thinkorswim desktop software platform. And I set out in the chat, buckle up a little bit here because we're going to jump right into a particular trade. We're looking at the Russell 2000 index here. We're going to look at a specific trade here, a short-term calendar or time spread. So I'm going to put the trade on, and I'm going to talk through the trade as we do this. And then I'm going to come back and I'm going to explain the methodology behind this particular approach in this particular trade. So here we go. I'll kind of define where we are. The market ahead of a Fed day is kind of static at the moment. It's not really moving a lot. The Russell kind of staying once again kind of right in this range up against a resistance about the 2060 level. So what I'm going to do is I'm going to pop over here to the trade tab. And in the trade tab for the Russell 2000, remember this is a European style index, which means that short options or options in general cannot be exercised until expiration, which means that it takes that early assignment risk out of the equation. That's normally a consideration when we're looking at selling options is early assignment risk. So here's what we're going to do. We know that the market's currently trading right around this 2060, 2065 range or so. I'm going to come down to the 0 days till expiration. This is the expiration today that settles at the end of today's trading with today's closing print. And notice the implied volatility, given the fact that we're at a Fed day. That implied volatility on this series of expirations right here is about 63%. And we notice the dispersion between that volatility and the one that's 7 days from now on the 26th of March. And we go over to the right-hand side, and it's just a little under half of the volatility, actually a little bit more than half of that volatility in the front expiration. So 0 DTE, 7 DTE calendar spread is what we're going to do here really quickly. So we're going to go to the put side because those tend to be more reactive to implied volatility changes simply because they are used generally as hedging instruments. So I'm going to click on that expiration, the 19 March expiration. That's today. 0 days to go until expiration. Remember, we don't have early assignment risk because this is a European style index option. and I'm going to scroll down to our at the money strike. And actually, I'm going to cheat this a little bit because we're kind of sitting at about this 2065 mark. So you notice where we've got our at the money strike. It's kind of bouncing here between the 2060 and the 2065, 5-point wide. We're closer to the 2065, which is slightly in the money. I'm going to look at the 2060 because I think we're going to see maybe a little bit of a push, a little bit to the downside, right? So Jerry, this is going to be a new trade. This is our calendar spread on the Russell 2000. So we're going to go to the 2060 strike, okay, which is right about where we were seeing that resistance level. And you notice that bid-ask spread kind of is bouncing back and forth a little bit tighter bid-ask spread at the 2065. I've got a choice. I'm making a conscious choice to go to the 2060 simply because it's all extrinsic value. The 2065 is extrinsic plus a little bit of intrinsic value in this particular case. So I'm going into the 2060 on purpose simply because of that volatility dispersion, the fact that this is all extrinsic value because it's out of the money. I want to sell an expensive option to start this calendar spread. So I'm going to create this by using my control key, okay? And I put my control key on and I clicked on the bid price. So we'd be selling this one for $10.40, okay? Now, next step, I'm going to go to the 7 days to go until expiration. This is the 26th March. And you notice that its implied volatility is about 27% relative to the 63%. So I'm going to go to the 26th March expiration. We're going to go to exactly the same strike. That's what's going to make this a calendar spread. So here's the calendar spread, the 2060 strike. Okay. And I'm going to buy that 2060 strike. So here's the deal. I'm creating a trade that is relatively low cost. Now, if we talk about risk management, if I click on confirm and send, you can see the cost of this trade and its buying power impact is $1,775, right? That's because of the spread. We don't have early assignment risk, so there isn't that possibility that we're going to be assigned on the short side ahead of expiration. So I'm going to chart this now that we've got this trade on. Let me put this trade on really quickly so that we can get it in there and get it working is an example, because remember, this is an illustrative and educational example. And then we'll throw this on the Analyze tab and we'll talk through this. So what I'm going to do is I'm going to click on Confirm and Send once again. Read through this order, make sure that that's what I want. Buying one calendar spread, right? So this is a debit spread out of pocket. The maximum we can lose in the trade is what we have put into the trade theoretically. We're not going to look at rolling this and extending this calendar out by other expirations. We're simply looking at taking advantage of a potential increase in volatility. So I'm going to go ahead and I'm going to click on Send. And we're going to fire this order off. I'm going to put it in my index options group first. Click on Send and fire that order off, and we'll see if that fills. We may have to bump that a little bit because I was talking for a little while. We're going to go back over here to our working orders. I'm going to find my calendar spread right here, right-click, cancel, replace. We'll open up that lock a little bit and float that price. I'm okay paying $17.75, $17.80 on this. I'm going to open that up, go through the same steps, read through the order, make sure that we're aware of it, make sure that it's going to our index options group, and click on Send and fire that order off. And we'll see if that'll fill for us. It might not in the time that we're looking at this possibility. We're going to let that kind of sit and rest and see if that will fill for us here in this particular case. So that might come back in and we might get filled. Now what I'm going to do is I'm going to right-click and I'm going to analyze this trade. Jerry asked the question, did I consider the fact that we've got a Fed meeting? And that's entirely the reason why we're looking at doing this particular trade, right? So I'm going to take this one off, my butterfly spread that we looked at last week off, and I'm just going to look at this calendar spread. So I'm going to zoom this back in and I'm going to see, why are we not seeing our, oh, because it probably just filled. Let's see. Show all. And we're not seeing that spread. Let's take that one off, take that one off, take that one off. Okay, let's see. why we are not seeing that spread being displayed here. Let's see if we can get this to work. Best laid plans, right, guys? Best laid plans oftentimes go right. So let's see if we can do this. Let's see if we can bump that enough to get it to fill. And then we'll put this trade on. I'm going to open that lockup. I'm going to give it a little bit up to 1795. And we'll go through the process once again. We'll try to get this order filled. And it might not. There might be a little bit too much volatility in there. But let's go ahead and do this. Here's what I'm going to do is I'm going to come back over here and we'll go to the Analyze tab and we'll add a simulated trade, and we'll do exactly the same thing in this trade here. We'll add this simulated trade and we'll see if we can get this to work for us. So selling the 2060 and buying the 2060 a little bit further out. There it is right there. We've got that down here. It's the same trade. I don't know why we're not seeing it here in our risk profile. Oh, I know why. Because my expiration. Let's see. Let's go to our 26 expiration, March 26 expiration. We should still be seeing it in this trade. So for some reason, I'm not seeing that spread popping up in my graph. So we're going to have to kind of play this a different way. Here's and Ricebird says it shows up on mine. So mine. Let's see if we can even get break-even slices and see if we can get anything going on here. There's my break-evens. I know why. That's what it was. Okay. So thank you for bearing with me for just a moment. Here's our calendar spread. And here's what we've got. The idea being, in this particular case, is that we're looking for neutral movement, right? We're looking for two things to happen. One, volatility to crush in the front end as we get closer to expiration. Because remember, volatility as we get down to the end of the lifespan of an option tends to become less important, right? That volatility tends to crush. And we know that it's going to be all gone at the end of today. But number two, if we see movement on the part of the Fed in terms of uncertainty or any kind of discussion, it's very likely going to increase this level of implied volatility on the back expiration, right? The longer dated expiration. So the longer dated expiration going up, the front month expiration volatility coming down, that's going to work in our favor in this particular case, right? So we are doing this for the purpose specifically of a rise in implied volatility over the longer term and a drop in implied volatility over the short term. And you're right. There is a lack perhaps of open interest. Let's take a look at that really quickly. Now that we've got the trade kind of in place and mapped out and out there and ready to go, let me cut the number of strikes down here so that we can get to this a little more easily. So here's our 2060, and you can see that price has already dropped, right? On that, this index is going up just a little bit. So this is going a little bit further out of the money. So if we shift this, we might shift it to selling the 2065 if we adjust it. But let's take a look really quickly here at open interest and volume. And there is a little bit of open interest here, not a lot. We were looking at selling one contract. There's a little bit of volume going on, so it's not completely illiquid in this 0 days till expiration time frame. Certainly the 2065 has a lot more liquidity. So let's do this. Before this trade has a chance to go off at this point, since the market has moved just a little bit, I'm going to cancel this one. And we're going to replace this. We're going to adjust this trade. So what I'm going to do is I'm going to keep the same expirations, but I'm going to move this to the 2065 strike. Now, if I open my lock, that changes my debit a little bit here, right? Not a lot, but I'm going to go ahead and I'm going to click on confirm and send. We're going to read through that order. We're going to make sure that's what I want to have happen. Our maximum loss went up just a little bit because our price went up just a little bit, what we're paying for it. But there's a little bit more open interest at this 2065 strike. So I'm going to fire that order off, and we'll see if that helps for this to get filled in this particular time frame. And it might not. We'll see. But what we've done, again, that 2065 is now out of the money. So that's all extrinsic value, right? That is all extrinsic value. Here's the point of this particular trade, right? So in this particular perspective, is let's change our strikes here to the 2065 to match. The expectation is we want the price of the index, in this case, to end up today at about 2065, right? Kind of right at that discrete point. It might not. It might move one side or the other. So I'm going to change my break evens here, set slices to break even right here. So as long as it's somewhere between 2040 and 2091, that's our break even point on either side of this calendar trade. That would be breaking even, right? Going below that level or going above that level would be taking a little bit of a loss all the way to maximum theoretical loss. So how do we manage a trade like this? Well, one, we expect that we're going to take maximum theoretical loss. So we position size for that maximum theoretical loss. We don't put a stop on this type of defined risk short-term trade. But the other thing that we could do, and this goes back to what we talked about last week with the butterfly spread, is we could also put on an order to take this off if it achieves maybe 25 to 50% of its theoretical maximum gain. So theoretical maximum gain occurs kind of right here at this midpoint at that 2065 mark at expiration. So if we look and see where that maximum theoretical gain is, it's about 2294, right? So let's take this down. I'm going to take this down to one contract again, just so that we see this kind of in absolute terms. So we're paying roughly 1775 for it. And maximum theoretical gain is going to be somewhere up here around, so that's 1775, so about 1042 in this particular case. So if we were thinking about taking a maximum theoretical gain off of this trade and attenuating it somewhat, right, bringing it back a little bit and looking at taking some gain here, what we might do is say, all right, let's take this amount, the 1775 that we are paying for this trade, right? And think about where our maximum gain is. If the price of the stock ends up, or the price of the index ends up kind of right at that 2065, what's our theoretical maximum gain? It's about we'll call it $1,200, right? So we take half that. Let's take that as 600, right? So let's even go, let's take half that, right? So if we take that and we say, look, we take our 1775 plus $6, that's going to be about 2375. So that's what we're going to do to look at getting out of this trade, taking this off if we can sell it for 2375 or more. So when we go to this trade, what we can do, let's go back to our monitor tab, and we're going to go cancel and replace this order. We're going to edit this order, and we're going to change this from a single order to a first triggers sequential. Many of you have asked, how do you place a trade to exit a position once you've already put that position on, or while it's sitting there as a working order? This is how we're doing it. We're going to add this we're going to do a cancel replace. We're going to go to first trigger sequential, and we're going to now right click and create opposite order. So if we bought the trade to begin with, we're going to sell it to get out of it. We said we're going to sell it for 2375 or more. So if we can sell this spread for 2375 or more. Now, because we know that this is going to end at the end of the day. We don't need to change that from a day order. That can still be a day order, not a good till canceled order, because this is going to be done at the end of the day, right? So we're going to close this down. This is either going to expire, right? In which case we're left with a long put option, or we're going to close this down because it increases in value and we're able to sell it for more. And it's already started to move on us a little bit here. We can see that mid price moving around, but that's how we're going to set this order out. So what I'm going to do is, I know that that's moving just a little bit here. I'm going to float that lock open one more time here. And we'll see if we can bump that. I'll give it up to about 1801, but every time we do this, we're increasing our maximum theoretical loss in the trade. So we're going to go to confirm and send. We're going to read through this order again. Maximum theoretical loss is what we're paying for it. We're putting on an order to close this trade down, right? So if we buy it, if we sell it back for 23.75 minus the 1800 that we paid for it, that's going to be our theoretical gain in the trade. We might not get there. We might get some of that. So we're going to click on index options. We're going to send it there. We're going to click on send, and we're going to fire that order off, and we'll see if we can get that filled at this point. All right. And interesting. Thanks, George. That's good. That's a good point. George points out the fact that that kind of 50% level is about a third, about 50% of the area of the risk profile in that graph, right? That's that range underneath that level. Let me just grab my magic marker to show that here. I think that's phenomenal. And thank you for bringing that up. If we were to draw that kind of right here, that's the range that we're looking at taking some gain off of this trade. Maximum theoretical gain comes if we hit the target right here, and we might, but we're going to take that trade off if it gets into this area right there and gains some of that maximum gain. So good point, and good some good insight into that part of the discussion in terms of managing this trade. All right. So I wanted to get that trade done. I wanted to do that really quickly just so that we can see how that works. And the idea behind it is very simply this. Let's go back to the chart. Let me delete my little drawing there. I told you to buckle up. The idea was that this index, the small cap index, is likely to kind of stay right about where it is. We've got a Fed meeting coming up. It's very likely, but not a guarantee, that the Fed is going to leave interest rates alone, which the Russell 2000 is sensitive to interest rates, but they might also say something that is indicative of what their future plans are. That could create either more volatility or less volatility. So we're kind of covering ourselves on both sides of the equation. If the implied volatility ramps up on our long leg, that's fine. If the implied volatility crushes on our short leg as we get close to today's expiration, that's fine too. Both of those work in our favor in this calendar spread. Buying and selling in the close to expiration time frame, buying in the longer dated time frame, same strike creates a calendar spread. That's the type of spread that we put on. All right. Okay. And I'm going to go back to that Russell butterfly that we put on last week. So let's go back and let's take a look at that. I'm going to go back to the Analyze tab. And I'm going to take this one off, and we're going to look at that butterfly spread that we put on last week. And here's the thing with this butterfly spread, right? Let me take these out of the equation just so that we get to that particular risk profile graph. So let me kind of stretch this out so that we can see it. We'll stretch and move and stretch and move and stretch and move and stretch and move and stretch and move. So here's the trade that we put on last week. This was the butterfly spread. I'll take this one, and there it goes. It filled at 1790, and we'll see how that does. So here's the butterfly spread that we put on last week, right? And the expectation was very small loss, right? We paid 40 cents for it. And we were looking at potentially taking the trade off if the trade we put in an order to take this trade off, if it made about 50% of its maximum theoretical gain, which in this particular case was almost $10 when we were looking at it. So we were looking at taking the trade off right around the $5.50 mark. And so we put in an order for that trade to take that trade off at that level. Well, guess what happened the very next day, right? Guess what happened the very next day at market open when volatility moved and prices started to move around? That trade went out and closed out at that price at which we put that order to sell it back for $5 and I think it was 20 cents. So let me show you what that looks like. I'm going to go back here to the monitor tab and I'm going to go to the account statement. And here's our butterfly spread. Okay. So here's our, I'm going to go back, let's go back 8 days from now, just so that we've got those in place. So here's our order to buy the butterfly spread. We bought it for 30 cents. And here was our order to close that butterfly spread down when it got to $5.50. It got to $5.50 the next day, right? The next day. And it went out, it closed that trade down. So we bought it initially for 30 cents and we closed it for $5.50. We saw 50% in this case of our maximum theoretical gain in the trade. That does not always happen, right? That does not always happen. And so that's kind of the perspective on this particular trade. That's why if that trade did not fill, if you're still managing it, we can see what that trade is currently trading at. So we're going to go back to our Analyze tab. And if we float the lock here on this debit, we can see that that spread is currently trading at about $1.05. Well, we paid 30 cents for to begin with. Now, if we're kind of in this particular perspective and it expires in 2 days, this Friday, you could a trader could close this trade down from the perspective of buying it for 30 cents and selling it now for $1.20. That's some theoretical gain in the trade, right? Not maximum theoretical gain, not 50% of the theoretical gain, but you can see where that trade is. And in terms of the risk and the position size in this trade, I want to kind of come back to the position size in this trade. When we put this trade on to begin with, our debit was 30 cents. So if I right click and I click on confirm and send and I look at a debit of 30 cents, what's the buying power impact of a butterfly spread that's trading at 30 cents? It's $30, right? It's $30 on an index with the potential. So that's what I said. This is a low cost to enter. So if you're position sizing, and let's say your position size calculation in a particular account might be, let's say you've got a $50,000 account and that's $5,000 or there's 50,000. And you want to divide that by, say, for instance, 1%. That means that you're going to risk $500 in any one particular trade, right? We've done that kind of fixed fractional position sizing math before. So $500 in any one particular trade divided by $30 of trade risk. That's the absolute risk in that trade, right? That's the theoretical maximum risk in that butterfly spread. If we bought it for 30 cents, that means you could trade 16 iterations of this spread and stay within that maximum theoretical risk, which means then we could take this hypothetical trade, this simulated trade, and we could bump this up 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16 16 contracts, right? Now, if we right click and we confirm and send, you can see what the impact is. Maximum theoretical profit, if it goes to max gain, which it didn't in that first iteration, would be 15,520. Maximum theoretical loss in the trade, $480. That's 16 contracts. Now, I'm not saying and never do say bump up the number of contracts, right? But it's been requested several times in the feedback surveys, talk about position sizing for these types of trades on index options. So that's what we're doing, is kind of working through this position sizing discussion, right? So from this standpoint, bumping the number of contracts up, then you've got to start paying attention to, or trader has to start paying attention to, open interest and volume in terms of getting those orders filled. The more you ramp up the number of contracts, the bigger part of that open interest you become. So that's something to pay attention to. All right. So let's continue our discussion here. Let's go back to our monitor tab, and we'll go back to our activity and positions page. Now that that's currently working for us, there's our filled order, and that's working in our favor. At least at the moment it is. And we'll see if that continues to do that. But let's go to our weekly index options discussion, our 14.7. So here's the thing. We sold this vertical spread, this short vertical spread, for $1.70, right? It is now trading for 90 cents. So we've got a little bit of a gain in this trade. Let's go to the chart and let's bring up our index grid. And here's the SPX. This is what we have been doing 14.7. Selling it 14 days to go until expiration, buying it back at 7 days to go until expiration. So we had kind of a technical toggle point. I'm going to add that technical toggle point here on the chart, SIMP, simple moving average. And we're going to make that simple moving average the 200. We're going to make that a green color and 3 points wide. Click on OK and apply and OK. So our toggle point was the SPX trading above or below the 200 period moving average. In this particular case, since it's still trading below the 200 period simple moving average, we are selling call spreads. When it was above the 200 period moving average, we were selling put spreads, because our trend definition determined that from a technical analysis perspective. Now that the index is below the 200 period moving average, we've been selling call spreads, expecting further potential downside movement or neutral movement. And what we've done is we've gone to the 14 days till expiration time frame on our probability of expiring cone, which is one standard definition or standard deviation in price movement from a probability standpoint, and we've sold our short strike at that intersection of 14 days to go until expiration and one standard deviation. So let's go to the trade tab. Let's change this to SPX. And we're going to look out and we're going to see where is our expiration that is 14 days to go. That's the 2nd of April. So we know where that's going to be. We're going to go back to our chart. We're going to find that horizontal or vertical line, 4.2. And where is our call side? That's going to be 58.89, probably 58.90 is our strike price. We're just going to put a line there at our intersection so that we can see where we're selling that short strike. We're selling far out of the money, expecting that price movement on the index is going to stay below that level, right? We'll say we're going to stay below that level. Now, here's what we're going to do. We're going to go to our trade tab, and we're going to do this relatively quickly. So we know that we can close this one down, and we know that we're going to sell one in this next iteration. So what I'm going to do is do these as two separate steps. So we're going to close this one down, and we're going to get what we can get out of it. In this case, we're getting about 70 cents out of it because it's now trading at $1. It's gone back up a little bit in price. I'm going to right click. I'm going to create a closing order, and I'm going to buy back this vertical spread. I could do this as a rolling order. I'm going to do it separately just so that we see the mechanics of it so that I can reinforce this on an ongoing basis. So we're going to buy back that vertical spread. Okay. And I'm going to click on send, and we're going to fire that order off. And we bought it back for 90 cents. Great. We made in that trade about 80 cents. Okay. Okay, now here's what we're going to do. We're going to come back to our 14 days to go until expiration. Cross-check our charts. We know that our strike is the 58.90 strike. We're going to scroll down. I'm going to have to add a bunch of strikes here to get to that level because we're going to be on the call side, and I want an out-of-the-money option that I'm selling. We're going to sell an out-of-the-money short call vertical. So I'm going to scroll down all the way through. This is 75 up, 75 down as far as the strikes are concerned. So I'm going to go to the 58.90 strike. I've got to go all the way out here, and I might not even get it. There it is, 58.90. I'm going to sell the 58.90 strike, which, let me change my layout to Delta here so that we've got Delta in place. The 58.90 strike, that's the one that I'm looking at, is about a 10-cent delta in this particular case, right? So oftentimes we've seen that at about the 15-cent delta. When implied volatility was higher, it was at about that 15-cent delta. Now we're at about the 10-cent delta. Implied volatility has kind of come back in a little bit since we were looking at doing this last. That's okay. We're going to use that one standard deviation line as our definition. So we're going to sell the 58.90 strike. I'm going to hold my control key down, sell the 58.90 strike, and we're going to buy the 5900, right? 10 points wide on this vertical spread. And we're going to sell it for $1.20. Okay. We're going to sell it for $1.20. Okay. So here's what we're going to do. We're going to say, look, selling that for $1.20, if we click on confirm and send, here's our theoretical maximum loss in the trade. Because remember, we don't have early assignment risk. This is going to be a shorter term trade, 7 days, selling at 14, buying it back at 7, and our buying power impact in this trade, so talking about position size, is $880. So if our max theoretical risk in any one particular trade is $500, this is too large for that potential max risk. So what could we do? Well, you could use a smaller instrument. You could use the XSP, the smaller index, and I'll show you how that works here in just a second. But we're going to go ahead and we're going to put this in our index options weekly group, and we're going to click on send, and we're going to fire that order off, and we sold it for $1.20. And then how we're going to manage this, right, in this trade is the way that we've been managing this is taking it as it comes. We're not going to put a stop on it, and we're not going to put an order to take it off at a percentage of profit. What we're benefiting from here is the rapid acceleration of time decay in a far out of the money option in the first few days of the trade, as opposed to an at the money option, which is relatively slow when the trade is put on. Does that make sense? We've talked about that time decay curve before of an out of the money option. That time decay curve looks a little bit like this, where an at the money option time decay curve looks a little bit like this. So it almost inverts from that in the money, right? So Priya, going back to the discussion, why did I choose to do a short call vertical instead of the short put vertical? Here's why. Here is the sole reason why we're looking at doing a short call vertical in this case, as opposed to a short put vertical, because the index is under the 200 period simple moving average, which means that right now, still, it is in a downtrend according to our definition. So we're expecting that price is going to stay at or below our short strike, the 58.9 or the 58.90, right? Above or below the 200 is our toggle. Below the 200 period, we're selling call spreads. Above the 200, we're selling put spreads in this idea. So that's kind of the thought process. This is simply an exercise in kind of following trend, managing trades, and looking at taking advantage of the circumstances that we can take advantage of. It's not a home run trade, and it is a trade that is one that requires management on an ongoing basis, as all trades do, right? Nothing is a set it and forget it perspective. But the idea is we sell it when implied volatility, we get enough implied volatility and the price of the stock or the price of the index is not likely to be there. We don't have short assignment risk. And when we get hit is if the index makes a big move, right? And that is a $10 wide spread, right? $10 wide spread, which is what we've been doing consistently. And you notice what's happened is as this has come back up, as the index has come back up a little bit, we've gotten a little bit higher in our one standard deviation line. So we've moved it to that range as well, right? So the 200 period, Ed, to answer that particular question, the 200 period is still pointing up, right? It is still a bullish trend, but we're below that 200 period. So we talked about this a little bit last week in that this trade, this 14.7 kind of gets lost in the transition. So if this is sitting right at that 200 period moving average, kind of on the cusp, on the great divide between above or below, then it's very likely that this is going to be subject to volatility and we may take a loss, right? And that could be a signal to get out of the trade, Jerry, in answering to that question. If we saw this move quickly above the 200, then yeah, that could be. But I wanted to do one thing before we get away, because I wanted to, again, reinforce position size ideas here, because that's been requested. So if that, because remember, creating this trade now creates a loss potential, max theoretical loss potential of about $880 in the trade based on what we brought in, right? But if we were to change this to XSP, okay, this is 1/10 the size of the S&P. Same trend, same characteristics. This is a different instrument, so it's going to trade differently, but slightly. And any exaggerated differences between the XSP and the SPX are going to get arbitraged out very, very quickly. But the same thing here. So we're going to go to the same strike, but this is going to be the 589 strike. So we're going to go to the trade tab here for XSP, and we'll look at putting together exactly the same trade. So we're going to go to the 14 days to go until expiration, and we're going to go to the 589 instead of the 5890. Because remember, this is 1/10 the size of the big index. So here's our 589, which means that we're selling the 589 for 85 cents. And we're buying the 590 which now shrinks that width to a one strike price width, right? Yep, that's right. There we go. And so we're selling that for 12 cents. Same thing, it just shrinks the amount. So remember the credit that we got in our big index vertical spread was $1.20. That would make sense. We're about 1/10 of that. And if I click on confirm and send, now you see what your maximum theoretical loss is here. It's $88 instead of $880. So that now fits potentially with the position size rules of a smaller account. And Priya asked the question, is XSP also European style like the SPX? Yes, in fact, it is. So Ricebird asks the question, would there be an issue to add quantity to this? And so one thing to think about is when we add quantity, one of the things that we have to pay attention to then is volume and open interest. And so if we start bumping the quantity up, then we got to pay attention to that. And here in the XSP, there's not a lot of open interest at that 589 strike. If we take it back to the SPX and we look at volume and open interest on our spread here, and we go to the 5890, which is the equivalent, right? This is the one that we sold to begin with. We'll scroll down here. There it is, the 5890. And there was about 66 contracts of open interest there. So bumping it up significantly, you're going to be the big fish in a little pond. When it comes to open interest and volume, generally the thought is be a small fish in a big pond. You don't want to be the majority of the open interest, right? So there you go. All right, guys, great stuff. So, should we be concerned with low volume? Not necessarily. I mean, these are far out of the money. I'm more concerned in this particular case, and great question to ask. More concerned with open interest than I am with trading volume in this particular case in putting these trades on. All right. So there we go. That's what we've been doing. Let's kind of take a quick review here. Wow, that was kind of a whirlwind. We managed our trade here on our 714 strategy, and we added this calendar spread, which is kind of working a little bit against us here, but that's okay. I mean, the intent is this is going to go out. This is going to end today, one way or the other. We'll either end up with the spread gone by taking it off with our order to sell, or we're going to end up with a long put with 7 days to go or 6 days to go until expiration. And we covered some of the cost of that trade. In fact, we sold a majority of that implied volatility that's in the money option, or that at the money option in the long expiration. So calendar spread, vertical spread. We talked about managing our butterfly spread, and we looked at what the indexes are doing. Guys, it's going to be a fun day today with the Fed meeting. My thanks to Cameron May for helping out. If you want to learn more about these particular or any other strategies, check us out over here on the Trader Talks webcast page. And once again, my thanks to Cameron May for helping out today, and our great production staff for helping me out as well. Have a great day, everybody. We'll see you again soon. Take care. Bye-bye.